Financial repression and sovereign deleveraging risks and preparatory strategies. 1. Introduction and scope. You examine financial repression as a legal economic policy set that enables a sovereign to reduce real debt burdens by transferring purchasing power from savers to the public balance sheet, and you evaluate prudent advance preparation to avoid bearing disproportionate costs. Footnote. You study how governments shift real resources through design choices in money, banking, and regulation and how you can respond. 2. Definition and core mechanism. You define financial repression as the sustained engineering of real borrowing costs below the inflation rate through administered rates, captive demand for sovereign debt, and regulatory constraints that limit exit paths, thereby imposing a stealth levy on holders of nominal claims. Footnote. You recognize that negative real yields are a policy choice that quietly taxes creditors. 3. Historical use in the United States. You note recurring episodes that include the Civil War-era national banking framework requiring government bond holdings, the interwar and mid-century controls, Executive Order 6102 under Franklin D. Roosevelt restricting private gold, and post-war yield pegs until the early 50s that held Treasury rates below inflation. Footnote. You use prior American episodes to understand how statutory and administrative tools deliver below-market real returns to the state. 4. Debt dynamics at high ratios. You analyze how, at elevated debt-to-output levels, additional borrowing generates diminishing growth responses while interest costs compound, so that persistently negative real rates become the primary mathematically viable path to lower debt ratios without explicit default. Footnote. You accept that arithmetic, not rhetoric, drives the turn to repression when debt loads become self-reinforcing. 5. Instruments governments commonly employ. You evaluate rate caps and targets, preferential capital and liquidity treatment for sovereign paper, mandated holdings by banks and insurers, administered savings rates, and balance sheet facilities that insulate intermediaries from mark-to-market losses on government securities. Footnote. You anticipate policy that manufactures captive demand and socializes duration risk. 6. Capital controls and preemptive containment. You understand that repression is undermined if capital can flee, so authorities often tighten cross-border transfers, constrain monetary instrument movements, harden know-your-customer rules, and privilege on-ramp and off-ramp choke points before imposing real yield compression. Footnote. You expect constraints to precede the policy that needs those constraints to work. 7. Diagnostic signals you monitor. You watch for widening gaps between consumer prices and Treasury bill rates, proposals to relax leverage or liquidity rules for sovereign holdings, new standing repo or collateral facilities, escalations in reporting and outbound transfer scrutiny, and rhetoric that frames such moves as prudential stability. Footnote. You track the policy sequence because sequence reveals intent. 8. Portfolio positioning before constraints bind. You diversify custody and jurisdiction, hold a measured allocation to short-dated high-quality nominal claims while real yields remain positive, add durable real assets including physical precious metals with documented provenance, and maintain prudent fixed-rate liabilities on productive or resilient assets you would own through a full cycle. Footnote. You spread legal title, custody, and rate exposure so one lever cannot reprice your entire balance sheet. 9. Digital assets and payment rails. You recognize that decentralized bearer-style assets may resist direct shutdown while remaining vulnerable at the interfaces, so you acquire and self-custody in advance, validate backups, and assume future friction at brokerages, exchanges, and payment processors designed to channel flows into supervised vehicles. Footnote. You separate protocol-level resilience from gatekeeper dependence and prepare accordingly. 10. Legal compliance and reporting. You keep meticulous records, obtain tax counsel on cross-border holdings, respect reporting on monetary instrument transport and foreign financial accounts as applicable, and distinguish lawful reporting minimization from evasion, since compliance failures are an avoidable way to lose optionality. Footnote. You preserve freedom of action by pairing jurisdictional diversification with strict observance of the rules that actually apply to you. 11. Strategic presence inside the system. You retain conventional accounts and relationships to exploit mispricings that repression creates, since policy-induced distortions produce both overvalued and undervalued assets, and you avoid performative exit that invites adverse attention without delivering additional safety. Footnote. You keep one hand on the lever that can harvest the very dislocations policy makes. 12. Action checklist and conclusion. You act early by setting custody and jurisdiction, terming out any prudent fixed-rate debt, codifying an allocation to scarce real assets, documenting compliance, and pre-building controlled access to alternative rails, because once constraints arrive the cost of each step rises while feasibility falls. Footnote. You move before the window narrows since repression rewards the prepared and taxes the inert.